Well, time now for our ETF report brought to you by Invesco QQQ. We're joined now by Tom Lydon, CEO of ETF Trends. Tom, great to have you with us, of course, on this day that we get this news about that infrastructure deal. I guess the best question to ask right now is if you do want exposure to some of those infrastructure trades, what ETFs should investors really be looking at right now?
Well, there's a lot to choose from for sure, but the top 5 ETFs, if I can run through them quickly, are the Global X US Infrastructure Development ETF, over $3.5 billion, ticker symbol PAVE, P-A-V-E. Then iShares actually has 2, IGF and IFRA. FlexShares has NFRA, which is the Global Broad Infrastructure Index. And finally, SPDR, the S&P State Street Group, has their Global Infrastructure ETF, GII. But if you look at all of them today and you dissect them, a couple things pop to the surface that I wish it came out in your last segment. It seems that the winners in this infrastructure bill may be the rails. Biden talked a little bit about the support that he's got, not just for private rails, but public rails, almost 10% of the bill. And those stocks tend to be doing the best post his presentation today. Global X, PAVE, has a huge allocation to some big companies in that space. And in a couple in particular are Kansas City Southern, Union Pacific, CSX. So if you look at those stocks compared to other infrastructure type stocks, they're doing very, very well. One other big point that I think it's important to bring out is we've had a lot of discussion this last 12 months about commodities, the increase in the price and demand of commodities, and this infrastructure bill is going to put a lot of pressure on commodity prices. Areas like steel and copper, for sure. Energy is definitely going to be positively affected. Obviously, water, solar, they're going to be putting 5G to place in a big, big way. So there's a lot of positives that go there, but if you're looking for an energy commodities type ETF, the Invesco Diversified Commodity ETF, PDBC, has 15 types of commodities all wrapped in one if you want to pick one ETF.
Tom, what about outflows for a minute? Let's negate this and talk about where people are not putting their money right now or taking their money out of.
Well, what's interesting is we're having a lot of pressure with the threat of rising interest rates and inflation and the lack of clarity from the Fed. So the bond market, which was the big winner in ETF flows in 2020, has actually been seeing a fraction of that amount go in and some areas going out. So, for example, we've got $5 trillion in money market funds right now, a record, which means that a lot of people are taking their chips off the table and saying it's not worth the risk. At the same time, classic Barclays ag-related strategies aren't seeing a lot of inflows. Where we are seeing inflows in areas like alternative income sources, back to energy. MLPs are going to be great beneficiaries of this new infrastructure plan. The pipelines that are set up for oil and for gas in the U.S. have been in place for a while. They will be upgraded. And with Biden not being a fan of the Keystone Pipeline, it's going to be all on us to make sure that we're doing a good job here in the U.S. producing oil and gas and getting it to the right places on time.
So, Tom, obviously inflation has been a huge concern for the markets right now, and this infrastructure bill is only going to continue to help heat up the economy. If you are concerned about inflation, what are the best ways to hedge, do you think, moving forward?
Yeah, typically in the past, it was gold, and there are a lot of gold-related ETFs and gold miner ETFs. Unfortunately, gold has actually been in the back of the pack regarding commodities. So like the ETF that I mentioned, being able to buy into commodities and that pending demand that we're going to have commodities going forward, we really haven't seen inflation since the 1970s. And I know you folks weren't around at that time. I remember riding around on my banana bike seeing the long gas lines. So there's a whole generation of investors and advisors that don't know how inflation and the rising price of commodities can actually affect the economy. The best thing to do is, rather than be scared of it, lean into it and invest in those areas where you can actually profit or offset higher prices that you might see at the pump or in the supermarket.
All right, Tom Lydon, CEO of ETF Trends, thanks so much for joining us today.